What is going on, everybody? Q here from Hyperstocks. Today we're going to go over the S&P 500 and we're going to talk a little bit about what happened last week and what we can expect for the week ahead. So first things first, we'd like to talk about Friday. Friday's results were weaker than people expected. We can see that the market came down to its 50-day moving average. So the bottom wick of this candle represents the lowest point we went in the day, which happened to bounce right at that 50-day moving average, making our support for the week, or our main support for the week, 458. So we need markets to maintain that 458 mark in order for us to be in the healthiest possible position for us to move back up. The highest point that we went to on Friday was right to that 10-day moving average, which is that long wick at the top, which shows that the market went as high as 465 before moving back down and closing right around that 460 range. So our range for the week is going to be this level right over here, in between that 458 to 465 mark. So that's going to be our main focus. So as far as the S&P 500 goes, we are expecting a Santa Claus rally, which investors and traders around Christmas time, and generally speaking in history, we see markets begin to pick back up and move into a rally mode going into January, which is also called the January boom. So many of the investors and traders for this year specifically are questioning if we're going to get a Santa Claus rally. And this is largely because of the Fed's most recent decision that came on Wednesday to bump interest rates up. So the Federal Reserve, if you do not know, is announced last week that they will be raising interest rates 3 times in 2022, which this has been a well-known fact for the last few months, and you can see that every time around the Fed's rally or the Fed's meeting, we see a little bit of volatility. For example, the meeting was on the 16th, and we can see that this week specifically, we started here, came down here, moved all the way back up here, and came down here. So anytime that the Fed speak or announce anything at all, especially during the times of COVID, we can expect a ton of volatility. But what they announced was already expected. This was something that they had already stated in a previous report. So the fact that we came back down may already have been pricing in what's already expected, and we could easily move back up from here and push into the new year. The reason why is because we're not seeing any weaknesses in our major companies, where those large growth, high growth companies are still reporting amazing earnings, and markets are still very bullish on them. Now, another reason what we declined on Friday was because the S&P 500 paid out its dividend, and whenever a dividend is paid out, the stock or the underlying chart moves down exactly by the dividend price. So we already were expected to drop by $1.64 on the S&P 500 on Friday because of that dividend payout, and you can imagine that many people closed positions after they received their dividends. So the close wasn't a poor close. We're not really in terrible shape here. We're still riding at a very close level to all-time highs. So going into this week, we're confident that we're going to get a strong end to December and move into a great January, especially in the large cap stocks that are still reporting amazing earnings. Now, other focuses for this week are going to be the Personal Consumer or Consumption Expenditure Price Index, which is the PCE report. This is what the Feds primarily watch to measure how much people are paying for goods and services, and it measures inflation or deflation. So if you don't know, inflation has been playing a ruthless part of the market uncertainty right now across the nation, being at a 30-year high. Therefore, anytime these reports come out, like the Consumer Price Index or the PCE report, we see markets to be very reactive. So we get a knee-jerk reaction from investors on the day. So that's expected to come out on Thursday, which leads us into a 3-day weekend. So we will be closed on Friday, Saturday, and Sunday because of a Christmas holiday. So we may see a little bit of volatility on Thursday if we don't get the best report, and traders may not want to hold over a 3-day weekend. So the approach for this week is to try to get in and out of positions within the 4 given days and be mostly cash by Friday, which is going to be a day in which is not trading. So our approach is to capitalize on the Monday through Thursday moves, and then Friday go into it with a full cash position that we're comfortable through the 3-day weekend. But I hope that helps, and best of luck.